Wall Street is finally waking up to the reality of inflation. 2% inflation is a thing of the past. We're not going back down to 2. In fact, we're not even going to stay at 3. We're going to have high inflation as far as the eye can see. All the government can do is lie about it and hope we don't notice. But Wall Street is finally waking up and noticing this. And this is not the end of something. This is the beginning of something.
UBS, when gold started to move, was one of the only bullion banks consistently conservatively friendly. And about $14 ago, they started saying, we're starting to like silver. And we suggest if you've got a lot of money and you understand the risk.
For decades, the financial establishment dismissed gold and silver as relics, defensive assets useful only in crises, but unworthy of serious portfolio allocation. That narrative is collapsing in real time. Inflation has proven stubborn, government balance sheets are stretched beyond precedent, and even the most hardened Wall Street skeptics are being forced to confront the reality that fiat paper is no longer the safe foundation it once seemed. We are entering a period where gold and silver are not just hedges, but strategic necessities. Peter Schiff has long argued that the official inflation targets are a mirage, and now even Wall Street is beginning to agree. His warning is simple, but profound. Inflation at 2% is gone, 3% is not the ceiling, and high inflation is here to stay. That shift in recognition is powerful because it marks the beginning of institutional repositioning, not the end. For the first time in his career, Schiff sees Wall Street actively recommending gold and silver exposure, not merely tolerating it. Just days ago, Morgan Stanley's Mike Wilson proposed a radical break from the traditional 60-40 model. His 60-20-20 allocation, with 20% explicitly devoted to gold, is a stunning admission that treasuries are no longer the ultimate safe haven asset. Gold, he argues, has replaced bonds as the anti-fragile hedge, the one asset that can protect portfolios when both stocks and fixed income come under stress. When the chief investment officer of one of the largest U.S. banks publicly endorses such a shift, it sends a signal to the rest of Wall Street, and the capital flows that follow will be measured in trillions, not billions. Vince Lanci brings the second critical piece of this puzzle. He highlights that UBS, one of the most conservative bullion banks, has not only raised its silver price targets, but also openly encouraged investors to buy physical and paper exposure alike. This isn't speculation from fringe commentators. It's recognition from an institution that built its reputation on caution. UBS sees silver shortages building and anticipates that silver will outperform gold in the next leg higher. That convergence of Wall Street suddenly embracing gold and UBS flagging silver as the next strategic asset is a seismic shift. Stay tuned as we break down Schiff's urgent warnings, Lanci's deep analysis, and why this signals a new era for precious metals and beyond. If you find value in these insights, make sure to like this video, subscribe for more analysis, and drop a comment with your thoughts on whether you believe gold and silver are finally stepping back into the monetary spotlight.
I think Wall Street now, and I mentioned this last week, now that you got Morgan Stanley is saying we have a 60-20-20 portfolio. You've got Wall Street for the first time in my career. I've been a stockbroker since 1987, and I've been in the investing business. And for the first time, I'm not the only one telling people to buy gold and silver. Wall Street is now saying the same thing. And 20% of a portfolio in gold, that's a big percentage. That's not chump change. That's a lot of money that's going to be coming in to gold. Now, not all at once, but pretty much every day for the next several years. I think it's the beginning of a huge wave of money, Wall Street money, that's going to be coming out of bonds and other fixed income into gold and gold-related equities. Because now, Wall Street is not worried about gold prices crashing, which they always were. Now they realize gold's going up, so these gold stocks are a bargain. And what's great about the gold bull market now is what it was missing before. Silver is now leading the way. That is a bullish sign. People always pointed to the weakness of silver as a lack of confirmation because all big gold bull markets, silver leads. Well, now silver is leading. Gold was up 0.5% today. Silver was up 2%. Silver closed over $46. It traded over $46.50. Silver was up 8% on the week. So if you bought silver last weekend, like I told you to in this market wrap, you're already up 8%. Gold was up 2.2% on the week. Year to date, silver's up 59%. 59. In fact, when it was at its peak, it was up 60%. Then it pulled back a bit. Gold is up 43% on the year. And the year's not even over. We got 2 more days left in the third quarter. I think the fourth quarter is going to be the strongest yet for gold and silver. And as I just mentioned, these next 2 days, a lot of portfolio managers are going to want to show their clients that they have some exposure to gold and silver, right? Better late than never. Of course, it's not late, but it's late in the quarter. So I think they're going to, window dress their portfolios. They're going to add some gold exposure if they don't already have it. So you're going to see, I think, money coming in to gold and silver and the mining stocks over the next couple of days. By the way, that was the other knock on the bull market, that it wasn't being confirmed by the mining stocks. They were lagging. They were underperforming because in every gold bull market, the gold stocks lead the metal. Well, that wasn't happening until now. The GDX was up 18% so far this month. 18%. The GDXJ up 20%. Year to date, the GDX is up 120%. More than a double, 120. The GDXJ is up 125%. So the gold stocks are more than double, in fact, triple the return on gold. So not only are they leading, they're way out in front. So we are firing on all cylinders. We have silver outperforming gold, and we have the miners outperforming the metal, right? It's all systems go. And we're just launching off now, right? And I think when silver breaks above 50, which it could easily do next week. I mean, this may be the last week that you could buy silver below 50, because I think once we break through 50, we ain't looking back, right? 50 is going to be support if we even test it. And we're going to go a lot higher than 50. But, we hit 46.5. So we just broke 40 just a few weeks ago. We got above 40 for the first time. And if you remember, what did I say? I said, once we break 40, we will make a beeline for 50. I said, we will get to 50 very quickly, right? And we are. 40 to 50 is happening a lot quicker than 30 to 40. That took a long time to get from 30 to 40. I mean, many, many months. And it just took a few weeks to get from, so far we haven't hit 50 yet. But I think we could easily do it next week. And by the way, look at the other precious metals. I mean, palladium, not too shabby, up 44% on the year. Look at platinum. Platinum was up 3.3% today, 12% on the week. That's the entire stock market S&P return for the year. Platinum did it in 1 week. Platinum's up 74% on the year. Now, we don't sell a lot of platinum at Schiff Gold. That's unfortunate. But, I was pounding the table because I wasn't really a big fan of platinum until earlier in the year when I saw how cheap it was. And on my main podcast, when gold was above 3,000 and platinum was still below 1,000, I was like, you got to buy platinum. You got to go to Schiff Gold. You got to buy some platinum because this is ridiculous. And yeah, look at how much it's up. It's still cheap. It's not as dirt cheap as it was, but I still think you're going to see some outperformance in platinum because it has a lot of catching up to do. And the same with silver. That's why I've been, recommending so much silver, because it has a lot of catching up to do. And I think it's going to catch up because what's been driving the gold trade is central bankers. They don't buy silver. They don't even buy platinum. They buy gold because the central bankers were ahead of the curve, right? They could read the writing on the wall because they were writing what was on the wall. But now Wall Street is finally waking up to the reality of inflation. 2% inflation is a thing of the past. We're not going back down to 2. In fact, we're not even going to stay at 3. We're going to have high inflation as far as the eye can see. All the government can do is lie about it and hope we don't notice. But Wall Street is finally waking up and noticing this. And this is not the end of something. This is the beginning of something.
Schiff's analysis underscores just how quickly sentiment is shifting. Morgan Stanley's endorsement of a 20% allocation is not theoretical. It is already forcing portfolio managers to move real capital into gold and silver. Schiff points out that silver is leading gold in this rally, a classic hallmark of powerful bull markets. Mining equities, once laggards, are now outperforming the metals themselves, with indices like the GDX and GDXJ delivering triple-digit returns. This is not retail speculation, this is institutional confirmation. And if silver breaks decisively above the $50 mark, Schiff warns, it will establish a new floor that could fuel an accelerated move higher. That dovetails with Vince Lance's assessment of UBS's silver outlook. Their upgraded report not only raised price targets, but signaled something deeper. Sovereign wealth funds, energy exporters, and even governments are beginning to stockpile silver. Unlike gold, which central banks can lease and circulate, silver is both a monetary metal and an industrial necessity. That makes shortages far more destabilizing. Lancey notes that UBS, historically conservative to a fault, is now telling its wealthy clients to buy silver outright. That represents a sea change in institutional sentiment, one that suggests silver may become the single most strategically important commodity in the years ahead. And that's where our focus now shifts.
UBS put out a report, and in that report, they updated their price target in silver, and they jumped it significantly, considering how conservative they've been. And they made special note. They made it a point of telling people that silver is going to fall. Their phrase doesn't fall in line at the level of gold. So they're actually calling for the gold-silver ratio to drop, and they believe that silver is going to outperform in the next leg higher. We think that's really significant, not just because it agrees with us, but because it's a sign that either central banks are not going to be buying gold as much anymore, or someone else is buying silver. Is it a central bank? Probably not. Not a Western central bank for sure. They're probably still wrapping their head around if they should buy gold or not. Is it a sovereign wealth fund in Asia? Yeah. Is it a Saudi Arabian or UAE firm that's buying SLV for the government? Yeah. Is it Russia buying it as a critical mineral? Yes. Is it the US adding it as a critical mineral? Yes. So it's everything but a monetary asset, which is why I say gold is money, but silver is more. Silver is more important than gold. You could always get gold from someone. They will lease it at a price for someone, for something. 10%, 20%, 30%. You can't get silver when you need it. Silver is more than money. So excerpts. Silver has surpassed the US $44 mark, marking a 14-year high, supported by a record gold price and strong investment inflows, despite a stumble in global industrial activity. Additionally, as rate cuts progress and the industrial cycle turns up, we expect silver to outperform gold, with the ratio between the two dropping further towards 80. Well, we could be getting there a little sooner than you think. With this move, we flag that silver prices could reach an all-time high, a view that supports a long position in the metal, or selling its downside risk for yield enhancement. UBS, when gold started to move, was one of the only bullion banks consistently conservatively friendly. And that's because back in the day, UBS had business that bought precious metals. They weren't producer operators. They also had buyers of the metal, and they were very responsible in raising their targets. Always slightly ahead, almost never chasing, but never getting euphoric. And they were showing caution all the time. And about $14 ago, they started saying, we're starting to like silver. And we suggest, if you've got a lot of money and you understand the risk, selling puts, put spreads, meaning you don't mind taking delivery if you lose money. And we noted that, and we made subscribers aware of that. And over time, they kept saying that, but they were giving strikes at the 26 area. That's a good place to short the put. The 28 area, 32 area, 35 area. And now here we are at, when they wrote this, at 42, and they're saying, sell puts. That's crazy for me as a risk manager. But if you're a billionaire, maybe it's not crazy. But now they're also saying, just buy it. They're not just saying sell put spreads, they're saying buy it. So I think this is a significant move for them. And, well, they were right about gold without being parabolic. I think they're right about silver.
The implications of these parallel analyses are enormous. Wall Street's newfound embrace of gold represents a fundamental rewriting of investment orthodoxy. For decades, the 60-40 model was gospel. Today, it is being replaced by a model that acknowledges bonds are no longer reliable diversifiers in an inflationary world. Gold, once dismissed, is now the anti-fragile asset that major banks are openly promoting as a cornerstone of portfolio defense. That shift is not just about price action, it is about credibility. When mainstream institutions begin validating what contrarian voices have argued for years, the momentum becomes self-reinforcing. Silver, however, is the real wild card. Lancey's observation that silver is more than money gets to the heart of why UBS's upgrade matters so much. Gold is accessible. Central banks can lease it, trade it, and mobilize it. Silver cannot be conjured on demand. Its dual role in industry and finance makes it uniquely scarce when supply chains tighten and demand accelerates. A shortage in silver is not merely a financial inconvenience. It is a systemic risk with geopolitical consequences. That is why sovereign wealth funds in Asia and the Middle East, as well as countries like Russia, are rumored to be accumulating aggressively. The world is quietly preparing for a silver squeeze, and when it comes, it will be too late for the unprepared to act. For well-informed investors, this confluence points to one conclusion: the precious metals complex is entering a structural bull market. Gold will provide the bedrock of institutional hedging, but silver has the potential to deliver explosive upside as both an industrial and monetary asset. And here's where the broader implications become even more intriguing. As distrust in fiat systems grows and tangible assets reclaim their role as the ultimate form of collateral, crypto markets, particularly Bitcoin, stand to benefit from the same dynamics. Both gold and Bitcoin are seen as alternatives to the financial system's over-leverage, and as capital seeks safe havens, digital scarcity will complement physical scarcity. The writing is on the wall. Inflation is entrenched, Wall Street is moving into gold, UBS is ringing the alarm on silver, and a global realignment of money is underway. For investors willing to see beyond the noise, the opportunity is generational. If you found this breakdown valuable, hit the like button, subscribe for more in-depth analysis, and share your perspective in the comments. Do you think silver will outperform gold in this cycle? And what role do you see crypto playing in this transition? Thanks for watching, and stay prepared, because the shift is happening faster than most realize.